Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hey everyone, welcome to the latest edition of On the Edge, Way Capital's podcast. I am thrilled and excited to have Michael Cohen, Chief Investment Officer, Managing Director at Lenox West, join us today. Michael, welcome to On the Edge.
Hey, thank you for having me, Malcolm. I'm excited. Let's do it.
Rock and roll. It's great to not only have someone we've done business with, but it's also great to have a neighbor on. So it's good to see you in the 2D, but I get to see you all the time. So Michael, maybe if we could we get a little bit of background on Lenox West, who you are, what you're doing, and also, give us a little bit of your personal background, how you ended up in commercial real estate and particularly in investing like you do at Lenox West.
All right, let's start off, let's go in chronological of how I got into real estate. I got into real estate just because I wasn't really sure what I wanted to do. I went to Emory undergraduate business school at Gazetta. I went straight to law school. Law school, I learned an incredible skill set, which I realized could be captured in anything in the future professionally. I also learned I didn't want to be a lawyer. I then worked for a company called Rubenstein Associates in public relations, which was Richard Rubenstein, the son of Howard Rubenstein. Howard Rubenstein is basically the inventor of PR. And Richard, based in New York City, I'm from Long Island originally, went back to New York after Emory for my graduate school, and also went to NYU for my master's in real estate finance and investment too. But at Rubenstein, I would be on calls with the Trump Organization, Zeckendorf, a lot of the international brands, and was doing new business agreements, and also some fun things, when A-Rod was dating Madonna, handling that PR, Carmen Electra, just kind of some goofy things. But I would go to all these real estate meetings and I got the bug, realizing I did not want to be in PR, especially on the new business legal side. I then went to work for a small shop in New York, where we would create models for public and private retailers like Lacoste and Gucci and Puma and Lumber Liquidators. We would determine what markets to enter, and then where we would then negotiate the deals. I did that for a couple of years, realizing at that point I also wanted to be on more of the investment side than just kind of this kind of retail consulting. And that's when I went back to NYU while working full time. And then I was engaged and married now to a wonderful woman who took a job in Seattle. And I moved to Seattle and just built a magnificent life and really, built my real estate career. I worked for a 7th-generation family office for a couple of years there, and then worked for Roseview, which merged with National Marquette. And I'm going to give a shout out to a mentor of mine, Josh Anderson, who really put me in positions whether I felt I was ready for it. He did, and you really learned to be comfortably uncomfortable. And it's great to have someone who believes in you before you believe in yourself. And I think that's what led me to partnering with Michael Cohen, my partner and co-founder at Lenox West Capital. And now I lead the investment arm for the George Krupp family office. George Krupp and Douglas Krupp founded they've been in the real estate industry for over 60 years. They're still the majority owner of a large multifamily company of over 40,000 units across the country.
I can't begin to tell you how many operators, developers, owners always come to us and ask us about, family offices, and family, everyone says family office. And there's so many different variations of what that actually means. There really isn't a pure definition of that. But curious how, first of all, the family office did find you. How did you get recruited? And, how do you all look at the world of commercial real estate investing, particularly in really, let's call it a volatile interest rate environment, to say the least, over the last couple of years?
All right, so there's a little to unpack there. So they first found me. I knew I think if you're in real estate, there's a generalization. you get to a point where either you're the CIO of the company or you're going to have to go out on your own, or you're a little stuck in the middle management. I realized that I always said in the back of my head, by my late 30s, I want to be entrepreneurial. So I put my hand up. I was still living in Seattle and spoke to a couple of recruiters, but a lot of people who knew me just through my different forums and that I participated on started to say that Michael would be a good leader of a family office with his traits. I've been on the institutional sponsor side, development, redevelopment, capital markets. And I think when you work for a family office, you need to be a jack of all trades, generally, especially when you are leading a new investment arm for them. I also think G3 technically was looking for a partner, similar age cohort, who had similar background and values. So Michael and I was speaking to 3 to 4 different groups, one based back in New York where I'm from. I almost took a role for a public REIT in the Midwest and, grew me for a CIO role in a couple of years. And then I realized I just couldn't move to the Midwest. My wife would not be very happy. But Michael and I hit it off. I wrote a strategy. And, this is now 2.5, 3 years ago almost. And we said, let's do it. Him and I decided to partner. One caveat is had to be Malcolm's neighbor in California now. Had to move from Seattle to California, which is tough. We still love Seattle, but we really love California too. And at Lenox West, it's really important for us to be a collegial family office. A family office, a lot of mid-size. I think I've heard something that if you have $2 billion of AUM, it's essentially you have 10 to 15 employees working for the family. And family offices, people don't generally leave. There's a reason for that. You're more of a stakeholder at the table. You get to see a lot of different things. And to Malcolm, your question, every family office is different. My partner likes to say, if you see one family office, you've seen one family office.
Yeah.
The way their processes are, family office dynamics. I like to call ourselves institutional types family office. We have an IC process. We have advisors, which leads to, I guess, the question of what we invest in and why we're here today. Given the background of the George Crawford family, they're a real estate family.
Mm-hmm.
So we invest only in commercial real estate on the housing sector as either a program, and we invest on the GP or as an LP. And we also invest in construction tech, property tech, mostly fund to funds. But we've done some direct deals as well.
All right. So if you're a real estate developer, an owner, and you wanted to get to think about how Lenox West is looking at today's environment and the opportunities that you find interesting, what have you been investing in? What are the things that you think out there are interesting that you're reviewing today?
So the legacy of the family has been housing. Myself and my team members, we come from private equity and investment banking. We wanted to be more specialized than traditional private equity, given the legacy of the family. We differentiate that way, having that much historical knowledge throughout basically every market in the country. It's and we also have a family office has its own balance sheet with legacy assets that dates 20 years, give or take. We only invest in the housing sector. Mm-hmm. And, when we think of traditional food groups in real estate, real estate's archaic. We're antiquated. Even cap rates are backward looking.
Yep.
So one of the things that, we try to do is think about, all right, what are the food groups? Food groups have changed. And where do we think the future of the food groups are? And then you look at the macro level of macroeconomics of this world, and obviously affordability is one of the primary crises in this country, if not the world. So we invest in traditional market rate multifamily, and also focused on built to rent and secondary horizontal land, manufactured housing, or groups that we've done homework on, or asset sectors in the housing space that we've done homework on that we believe will be more and more considered institutional core asset classes in the next 5 to 10 years, if not today. Like a student is also in that realm. Obviously, industrial is doing really well, but given where we think we could differentiate, housing makes more sense. We also done a ton of homework on markets. Being in Seattle for a long time and done deals in the Pacific Northwest, Utah, Denver, Mountain West. We've also done a ton of work in the Sun Belt, specifically the four markets that we're highly focused on in our middle market strategy are the I-35 in Texas, the Carolinas, both North and South Carolina, Southern and Central Florida, and Georgia. You can make an argument there's an oversupply today, which you can't argue that. But if you look at where absorption is being predicated by many economists right now, most of this is going to most likely be absorbed within the next year, if not within the second or third quarter, including Austin.
Yeah.
But our main strategy is, again, middle markets, middle market focus. So deal size is 20 to 80 million. Who really knows what the definition of middle market is today anymore? I feel like it depends upon where you are. And we look in industrial innovation and innovation hubs within the primary markets that I just mentioned. So we look at the ports. We look at, Tampa's becoming an innovation hub, obviously the Research Triangle, and obviously also the Atlantic periphery. And everyone knows what's happening on the I-35.
Sure. And then part of that is just, obviously massive levels of jobs that you are seeing in those innovation areas. But, maybe unpack that just a little bit further, because you obviously you're in the co-GP space. You invest in the GP side of the ledger. You also invest in the LP side. How do you make the decisions of who you are? Now, this is a very personal business. Who you do business with is as important as the deal you select. How have you made those decisions in the Lenox West platform and frankly in your career too?
So on the Lenox West platform, it's a lot of due diligence, especially when you're coming in as a programmatic GP. If you're going to do a deal by deal position GP, those check sizes could be lower than $1 million. So it makes more sense to do it programmatically with groups that you really believe are scale. So you're really looking at their going concern. We have a programmatic joint venture with an incredible operator called Magma Equities, focused in the similar markets that we are, including Tennessee, which I've got to mention. And we got to know them for a year before we decided to do a deal together. And we felt comfortable enough on that deal to do GP and LP, which now led into a programmatic GP that we will also help raise the LP, or if we, and at times, make do the LP deal ourselves. But I would say we when you're coming in as a GP, you're almost looking at your lender hat goes on with the amount of questions you are asking about the business, not just on the deal. And we don't want to spend our time on groups that we don't think can scale. I mean, that's the goal of being on the GP, is that you can scale the group, and potentially, if you have a great working relationship, maybe there's an operating platform play later on.
Sure. By the way, I'll give Magma a plug. He is a esteemed graduate of my alma mater and also my fraternity. So you've chosen well, Michael. Okay. So how, I guess, a lot of this on the edge stuff is about how deals can get unpacked and how they become executable, and the hidden elements of why deals get transacted on. In some sense, I've noticed that, you can be very good at sourcing opportunities. Maybe you're good at executing. I would make the argument you've got to be everything today. You better be able to source them. You better be able to execute them. You better be able to communicate. But, what are the things that the audience should think about, that you are thinking about in that due diligence period? Is it, hey, they've done this before for many years? Is it, hey, I really enjoy working with this individual or this team? They're obviously focused on one market only. Tell us a little bit about that.
So when we're looking at a sponsor, whether GP or LP, it's all about specialization. I might speak on both sides of my mouth, but I would say it's 99, if not maybe 95 to 99%. There could be a deal out there where it's just a deal is just so sexy, the opportunity is there, we could close faster, and it's a group that's maybe done one or two deals, but it's also a group that had experience from bigger shops that we feel comfortable in and had a true pedigree. But it's all for us. We want you to be an expert in your market, and you got to be an expert within that form of housing sector. There's two sides of that. We split it up between emerging and seasoned. So Magma to us, at this point, seasoned. They've done deals with some of the large institutional players like a Starwood as an example, and
Sure.
Franklin Templeton. So they've, give or take, probably bought about 10 to 12,000 units in the last 5 years. And they also come from institutional sponsors. There's other groups that have incredible pedigrees and then went on their own. And the question there, do you think there's one thing about being a deal guy, but can you run a business?
Yep.
And because if you're being on the GP, and I think that's what I think you're leading to, sure, we could put out $1 million and get a 2x on $1 million. It doesn't really, it's great, love it, but you're doing it for the scalability. We would like to put out 15 to 20 and then also get a piece of the carried interest, potentially fees depending upon how much work that we are also putting in to help with that sponsor. So you got to look at it on both lenses.
On the programmatic perspective, do you fund kind of operating overhead, pursuit expenses? Do you only come in once the deal passes due diligence? Programmatic can mean a bunch of different things.
It's an art, not a science, right? Versus traditional LP, right?
Yeah.
It depends. So could we come in for, support on guarantees and credit enhancement? Sure. I think this market, it's been harder, not harder. I don't think you've had to do that, just given how hard it is to find capital. But it's all market to market dependent. Leverage changes. We understand that. You also don't want to make your partner feel that they're being bludgeoned because you want to do future business. So it's a relationship. You're in a partnership for 3 to 5 years, if not longer, most likely. You want to like the people you work with. You really want to trust them. We do our background checks. We come in for up 50% and more on the GP, up to 90 to 95%. We take, somewhere, a decent amount of the promote because we're putting in most of that capital, but not more than, I guess it's better not to throw out numbers. Every deal is different.
Yeah, every deal is different.
But when I think about what else you asked about timing, it goes into the returns. If we're going to come in for land, could we? Sure.
Mm-hmm.
But we have a cost of capital we're trying to hit.
Yeah.
So there's maybe there's a true up. Maybe you come in 50-50 on land. I'm just throwing this out there as an example.
Yeah.
Or, in 50-50 all the way up to the LP on the vertical, and then you true up your position. Other times we are said, look, the market's too hard. We're only coming in, when we're ready to go vertical and bring on the debt. So
how about the level of fee discussion? Do you split in the fees that the GP earns in projects, or how do you?
No, we're not. Look, I would say that's the sponsors really need their fees. Otherwise, they're working for you. At that point,
yeah.
And some groups have to go that route. We try not to. We want them to grow a business. Sure. Otherwise, they're basically beholden to you as essentially your developer or operator. We do take a little though at times, but it goes into the blender of the return. For us, it's more that we're putting our time in. So sure. We might, if we're coming GPLP, we're also bringing on our owners reps who are great. If we're in the meetings with you on the entitlements. So if we're spending our time here and helping also bring on the LP, if we're not coming on the LP,
sure.
I think that we earn something, but we're not looking, I can say that this is actually easier to say, we're not looking to take more than 25% or less of the fee. And that 25% generally is the high side.
Sure. And so thinking about this in a way that, obviously you have great background in the LP market. Sometimes you decide to be an LP in your deals. Many times you don't, but you have all of these relationships in the LP market. So my understanding is that when you do come in on these opportunities, the GPs are really also leveraging not only your ability to provide GP capital, but you're really leveraging your LP relationships.
No, right. We are, I think there's various forms of GP funds and GP groups, many of which are passive. Sometimes I look at being a GP or a financier more than a real estate person. We are real estate people, at the heart of it. And we look at every deal. We help our teammates with their books, bringing them out to the LP, or we decide to do programmatic LP. We're on the calls with them. We help them with our Rolodex. I don't want to spend after a couple of years or the
sure.
first year or two, they should have those relationships where they feel comfortable. But our goal is to help scale the business on the GP and to be a good partner. So we're in it with them. I think our partners are really happy with how we help them with the debts positions at times, how we've also told the story. Because I think you hit the nail on its head, Malcolm. I've been on private equity world, the investment banking world. I've also been on the institutional sponsor world, and had to work with large sovereign wealth funds and pensions, being on that side of the world. And there is a way to tell a story, and we put on our LP hat when we're not the GP, when we are only in the GP.
Mm-hmm.
How are we? If I'm an LP, what are the questions that need to be answered? And we try to put that in the book. And we've been told. I guess I don't mean to, but we are. I guess I am putting a pat on our back with our sponsors that we've had some great books because of that.
100%. I think one of the reasons why you would partner with you is that you're able to. It is a 1+1=4 or 3 because they are partnering with you. Even if you've been a seasoned veteran in the industry, and I think you gave an example of a sponsorship group we both know well, but the reality is that's the reason, because you are creating a 1+1=3 to 4, and it's really exciting to see what you guys will do together. As it relates to just your sprinkle of kind of niches in housing, right? We talked a bit about obviously the built for rent space and traditional value add multifamily, some development. Are you involved in any of the more the niches like, manufactured housing or co-living or things of that nature? How are you looking at those niches per se?
So right now, co-living, we looked at some of the adaptive reuse plays from hospitality to residential. They're hard. At my former company, actually, they did it from the office to multifamily because they were based in DC. And after the GSC before COVID, millions of square feet were gone, so conversions started to happen. So I have history of, it wasn't my vertical, but learned from it from my colleagues who are excellent at it. From my former life, co-living's tough for us. I think it was a huge fad pre-COVID, and people more groups thought there would be more exits, and it just hasn't proven to be the case. And now urban infill deals are tough to come by right now, right? With net migration out to suburban 18-hour or suburban. We do love the manufactured housing space, but today that's a secondary vertical for us outside our primary verticals of built for rent and multifamily, value add and development.
And then also in the built for rent and the traditional multifamily, how are you kind of allocating your investment dollars or thesis between development and existing?
So it's funny. We just had our board meeting in Boston. It's good timing, Malcolm. Portfolio. Look, you have target portfolio theory, right? But it also depends on things you can mitigate in the market. Today, development's hard to make work, with the exception of BTR. Actually, I don't know. You're probably seeing this too. We're seeing cheaper debt for BTR deals now than traditional market rate of multifamily, which finally turned. It makes sense to us, but for years. But now that the lenders it's starting to, with the NOI deficit and the phasing of the deals, it makes more sense. But we are probably give or take 60 to 70% catered more towards development to value add today.
Mm-hmm.
Type of deals, and then allocation of BTR, a little higher allocation to BTR than multifamily, and then we like to put other boxes, which would be horizontal land. We really like that play right now of for sale, or potentially if you can't for sale with the home builders, potentially then sell it to BTR, just go up with a group. So a group that could go vertical or entitled to land is interesting to us on the horizontal side today. What else I would say?
Is that all similar markets too? So on the horizontal kind of land development selling to, I'm assuming you're selling to publics and regionals and things of that nature. But is there specific markets that you're doing that in, or what's that?
Well, similar. We like to say that if we're coming in as a GP, or if we ever potentially bring on third-party investors, shouldn't we be specialized for our investors too, and be experts in what we do? So how can I ask my sponsors? Being a private equity, potentially, we're definitely looking more on the private equity side of a family office. We think you really need to be focused, disciplined, and specialized. If we're asking that from our partners, how can I, and we're investing in them, if people invest with us one day, shouldn't they ask for the same things? That being said, would there be secondary target markets? Sure. But you need to be able to pivot. But those 4 markets I said earlier, including Tennessee, are our primary, and then just giving my personal history and my team's personal history in those Mountain West markets we really like.
Sure.
And Seattle, obviously, being there for so long.
We'd love to, it's an amazing market, a great place to live. What are the, just kind of as we kind of wrap up or get closer to the end here, what are you seeing? How do you see the latter part of the 2020s? As an investor, you have to make those. I know we don't like to do that, but how are you seeing kind of the macro trends, as you make these investment decisions? How are you seeing that 2027, 28 and the like? Because the projects you are investing in today, you're thinking about the exits at that time.
So the deal that we did together, built to rent deal along the I-35, we took a position of you had to take a risk in 23 to do a deal.
Yep.
And we took the position of where is this world by the time we deliver this in 26, give or take, and sell 27? You feel pretty damn good, especially if you really love the location and you believe that that location was had future deals all had the impact fees. Can't beat the location, couldn't beat the land pricing going forward. And we looked at it as, okay, if it takes a little bit longer on that built to rent deal with a sponsor that's done this throughout Texas, Lone Star. I should, if I use Magma, I should just say Lone Star is a great partner too.
Absolutely.
That where do we think we are? If rents don't go as fast, we love the real estate, we could hold it for another year or two. That's how we looked at it. But so going back to also my statement on oversupply right now in many of the markets that we're going long on, we think that concessions are going to be absorbed mostly, and this is also many of the brokerage and a lot of the data has proven this. I think it's starting to prove it that rent growth is starting to increase in a lot of our primary markets. Concessions are starting to stall, and if you look at real estate, unfortunately, as backward end looking, we're always thinking about forward looking. You feel pretty good about those markets, especially with, I think the Sun Belt today, I think what is it, 300 to 300 million people in the United States. What's the amount of people?
360.
360. I think 50% of that is now in the Sun Belt. In the next decade, it's going to increase to 55%.
Yeah. Of
the whole U.S. population. And that's just in the next decade. And then you put, when I mentioned the innovation industrial hubs, which now account for, there's about 8 to 10 hubs throughout the country, not just in the Sun Belt, but 5 or 6 are located there. That, in the next decade are going to account for, I think, a CAGR of 2.4 GDP, where the rest of GDP is only 2%. So put that in perspective. That's 10 major markets. So long story short, those markets we really like, and where I see the world, especially we're only housing focused, it's an inverse relationship with rates and valuations. We personally believe the American dream is changing. We're only a 250-year-old country. And you look at many countries of Asia and Europe, they're rental societies for a reason, because it's, capitalism is great, but it does cause valuations to skyrocket. So we believe in this rental society. We believe in, choice renters, workforce housing, and we need to build them. People have a right to live. I'm not trying to get into philosophy, but it's an important thing that we care about.
I mean, it's incredibly difficult to get projects out of the ground, as you know, and the fact that you've been able to get projects out of the ground in this market lends really well to what it's going to look like in the future years. But I think from every part of the country, it feels like it's hard to build. So it's hard to get them out of the ground, and hopefully we can deliver more.
I'll end it, not end it, but one last thing I think is important is you asked about, not specifically, but where are returns? I think there's going to be more of a go back to our normal return threshold. I think that's the hardest part for LP activity, that they look back at their last vintage and return expectations. So, when rates are at zero, you didn't have to do much to make money, if anything. Now I think you'll see the groups that are prevalent are the ones that are really good at what they do. They buy right. They understand how to operate and develop, keep costs down. And I think, are you going to get that return and what the spread is? I would hope so. I think you will. I think I think expectations of what, I think you've heard it all the time too, and you're doing the equity. I need a 7.5 untrended yield on cost.
Right.
It's unrealistic.
Luck.
I think there's so much powder out there, and it's growing from existing vintages that now have to go out and new vintages being formed. That will force powder out, which, look, they're going to make good returns, but return expectations are going to have to come down. It's better than the money just being feed by their investor. Their investors being feed on these funds.
Look, I think that's a great kind of segue to, this great conversation, because I think at the end of the day, having a practical look at the investment arena, something's got to give in the multifamily investment marketplace, which is, costs are not going down. Labor costs, while maybe coming down slightly, but not really to the point where the deals can pencil. Land, really difficult. So, return expectations likely have to be able to subside a bit. But Michael, I cannot thank you enough for spending a half an hour with us today. And, as your friend, I appreciate you affording me that 30 minutes. Hopefully the audience will appreciate this as much as I am. So thank you very much, Michael Cohen, for joining us today. All right, bud, have a great rest of your day.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.